let's now talk about the different phases, or of our lives and our property portfolio, to when to go for cash flow and when to go for capital growth. So, for somebody starting out there in their property portfolio, obviously they should just go for cash flow, right?
Oh, starting out in your journey.
I kid, guys. I kid. If you don't see the joke by video, the first property is typically, if you're younger, if you're in your younger years and you want to start a property portfolio, typically you're going to go for capital growth properties, right?
Yeah, well, capital growth, but also if you're younger too, you might not have that stronger income, so that balance between both. Okay. Once again, that's why you need to sit down and talk with someone to understand what best suits your life goals and your position. So there's no point investing at a younger age for just cash flow or just for capital growth. You want to get the best of both worlds when you're younger, because you have that propensity to earn that money and pay that debt down. And if you go for just capital growth, then more often than not, you don't have those higher income levels because you are younger to help grow your portfolio. So you could have that one and done situation, and then you obviously get good capital growth, but you'll always struggle to go for number two, which is going to help fast track your goals to financial independence.
Buying another property.
Yep.
Yeah. Because that cash flow, that mix of cash flow and capital growth is going to allow you to get a little bit of cash flow that's going to help you with borrowing capacity to go again, right?
Correct.
Versus if you just bought high capital growth and it grew in value, you still might be struggling even though you got equity to get borrowing capacity, right?
Yep. Yeah, pretty much.
So the first one, that you basically want a bit of a mixture.
Yeah, ideally in getting the best of both worlds, because that's going to help you pull equity out in the future, but also have the cash flow to go again. And then depends on where you're at with your portfolios too. So in the middle stages of your life, if you're just starting your journey, it's all a chess game, right? So you want to set yourself up for that success, and the middle path of both capital growth and cash flow is really important. And then those that start to grow their portfolio, you'll start to see either debt will start to be paid down and rents will increase, or they've got high cash flow properties in their portfolio, and then you can go, well, because you've got good cash flow being generated, you can now go for that more capital growth play in that less risky location of your major CBDs or minor CBDs, central business cities.
Yeah.
And then you're balancing it out as you go. And then in the later periods of your life, you're really hunting for cash flow. So ideally, you'd like to have paid down that debt over time, so those properties are actually giving you good cash flow that you bought 10 years ago, and then pulling equity out of those to then go into a higher income play like a commercial or a multi-income residential complex, like unit complex, like where you can buy 4 townhouses or something like that. You control the whole site. Really great income play. And then that's what you're retiring on at the end of the day.
Is cash.
Is cash.
Yeah.
Because you can, put it this way, if you retired and you had your property portfolio and the income from the rents was just paying off the final remainder of the debt and your maintenance and your rates, all that, what are you living off?
Yeah, you don't want to pull equity out, because then you're taking money from, and that you're paying, it's debt, you're just increasing your debt to cash, and it's going to cost you more to use that money because you've got an interest rate that you need to pay back, right? Because you just got for high capital growth properties alone without the mixture of cash flow.
Yep. And then, the sell down strategy is always wise as well. So a big part of what we do is help people find the best real estate agents to sell assets in areas that have peaked or are plateauing. And then you can use that in order to buy that next asset that best suits your portfolio, whether it's a capital growth or it's an income play.
So you're just assessing opportunity costs of where the properties are that you've got in these different locations, which ones are peaked, which ones aren't performing as well, sell down a few and either maybe buy some more or sell down a few and pay a little bit less in finance fees because you pay down some mortgages.
Yeah. I did a strategy the other day actually, which was the same property acquisition phase where 3 residentials, 1 commercial, and you will get to a greater, your income target will be faster if you buy the residentials, get that growth, sell the residentials down to then buy that 1 commercial. The risk in that is all your eggs are in that 1 commercial basket from an income perspective. However, you won't have that higher level of debt, so you'll be able to basically fast track to get to that income target. The next stage of that would be, well, you've now got this strong income, you've hit that retirement goal of 100,000 passive income. It's still good to have a capital growth asset within your portfolio. So let's look to go again into a residential to help marry it out.
Yeah.
But that will get you a lot faster to that income goal. If you want to take the slower route, then you just buy and hold and buy those 3 residentials, buy the commercial. At the end of the 30-year period, you're going to have, what was the equity? It was about $2 million difference in equity. So you have more asset value, which you can pass on to your friends, family, whatever your legacy plans are. But it'll take you longer to get to that cash flow goal of $100,000 because you carry that debt all the way through.
Yeah.
Does that make sense?
Yeah, versus like if you've got 2 or 3 properties, selling them off and then buying just a commercial that's higher cash flow.
Yeah, so pros and cons, and everyone's got a different risk appetite for it, and it also comes down to what the actual asset is that you're buying to give you confidence, because you can have a higher risk income play, say the commercial, but if that's a multi-tenanted commercial property, then you're de-risking that as well, because you've got, say, 4 tenants and
your income split between 4 different tenants.
Yeah, and then you're analysing those businesses that are renting it, you're seeing what their track record is.
Yeah. And one maybe moves out, you can do some renovations to that tenancy and then get a higher rent. So
yeah, generally the big, a lot of the real estate investment trusts run the commercial play because you're still getting that solid property asset. It's going to grow in value over time. Generally doesn't grow as fast as residential because it's more of a business income play, but it's a lower. There's lower maintenance because your tenants are paying your outgoings.
Yeah. There's longer leases.
Yeah, longer leases, usually 3 to 5 years. You can get people on 10 years, and you can also have a lot of confidence in the business that's renting you the property because you do your due diligence on that actual company.